Welcome to The Explainer. Today, we're putting on our equity research analyst hats and conducting a rigorous, highly clinical autopsy of NextDecade Corporation's financials trading under the ticker symbol NEX. We are going to strip away all the hype, tune out the media noise, and dive straight into the raw data as objective, investigative financial journalists. We're running this stock through the ultimate valuation gauntlet.
But first, let's lay down the ground rules. Disclaimer. This is an educational case study in quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, with that out of the way, let's dive into this.
Just look at this staggering paradox for a second. On the left side of here, we have a company with a market cap of nearly $1.9 billion and a massive enterprise value of $12.32 billion. But then you look on the right, exactly zero revenue, and a trailing 12-month operating cash flow of negative $224.7 million. It's like buying a multi-million-dollar mansion with a massive mortgage before you've even landed a job. Standard corporate math is going to seriously struggle to justify this. So here is our roadmap for today. First, the valuation gauntlet. Second, hidden red and green flags. Third, legendary investors reality check. And finally, the moat and final verdict. Okay, part one, the valuation gauntlet. We are going to systematically dismantle the data using over 20 standard corporate finance valuation models to see if we can anchor that $12 billion enterprise value. And what's truly wild here is how model after model simply shatters. Let's start with Group A, our cash flow and discounted models. Whether you run a standard DCF, unlevered free cash flow to the firm, free cash flow to equity, or even an adjusted present value model, the intrinsic value is totally negative or just incalculable. NextDecade has generated a levered free cash flow of negative $4.88 billion over the trailing 12 months, mostly driven by massive capital expenditures for the Rio Grande LNG construction. With zero revenue, discounted models just don't work. Now, how about Group B, our dividend and income models? Well, they pay no dividend, so the standard dividend discount model, the Gordon growth model, and the multi-stage DDM are instantly out. And if we look at the residual income model and economic value added, they're mathematically broken right out of the gate because the book value per share is negative 22 cents. Moving right along, this brilliantly illustrates the danger of taking metrics at face value. Let's look at Group C, the comparables and multiples. When we run a comparable company analysis or precedent transactions, the metrics get incredibly distorted. The trailing and forward PE ratio sits at roughly 40.83 times, but that is a pure accounting artifact masking a negative earnings per share of negative $1.38. It's completely meaningless. EV to EBITDA is roughly 196 times with zero fundamental anchor, and EV to sales breaks because, again, zero sales. And what about Group D, the balance sheet and asset-based models? Book value, net asset value, liquidation value, and replacement cost all tell a stark reality. With $10.6 billion in debt severely outweighing the assets, a fire sale liquidation leaves equity holders with absolutely nothing, $0 per share. So you are probably wondering, how on earth is this company worth nearly $2 billion in equity? The answer lies in Group E, advanced and options models, specifically real options valuation. This is literally the stock's single saving grace. By trading their future LNG cash flows like the underlying asset against a $6.7 billion strike price for the remaining construction, and then factoring in a 2 to 3 year timeline, this Black-Scholes logic yields a highly speculative $5 to $15 a share. In other words, the market isn't valuing this company on what it is today. It's valuing it purely as a massive call option on global LNG prices. Which brings us to part two, hidden red and green flags. Since the primary models are returning broken logic, let's pivot to some footnote forensics. We're going to ignore the basic headline noise and look at 7 deep red flags facing a media blackout right now. First, a negative book value of negative 22 cents a share. Why does the media ignore it? Because book value sounds like boring accounting jargon. Second, a debt-to-equity ratio of 377%. Explaining why a negative equity base makes this multiple explode requires a literal finance degree. Third, a current ratio of 0.37. Frankly, liquidity just doesn't make for a sexy headline. Fourth, a negative free cash flow conversion of negative $4.88 billion despite management constantly touting progress. Cash flow is boring, while first LNG in 2027 is exciting. Fifth, an interest coverage ratio of negative 0.81. Operating income doesn't even cover interest, a reality totally left out of most retail investors' vocabulary. Sixth, zero revenue with $10.6 billion in utility-scale debt. Calling it pre-revenue makes it sound like a fun tech startup, and that massive debt just looks like a typo to the casual observer. Finally, share dilution of 1.58% year over year, which requires complex explanations of option grants that analysts would rather just skip. But hey, forensic accounting goes both ways. Let's look at 7 overlooked yet incredibly fascinating green flags. 1. 20-year offtake agreements totaling 9.1 million tons per annum. Industry acronyms like MTPA glaze over retail eyes, but make no mistake, this is guaranteed future cash. 2. Construction is actually ahead of schedule. A cliché phrase for sure, but absolutely vital for their survival. 3. High institutional ownership at roughly 43%. It sounds like inside baseball, but it shows smart money is watching this closely. 4. Short interest is relatively low at 7.4%, mostly because explaining the mechanics of a short squeeze here takes too many paragraphs for a quick tweet. 5. Carbon capture integration, an undeniable ESG edge that's really hard to summarize in a quick soundbite. 6. The FERC regulatory process is advancing. FERC just sounds like alphabet soup to most folks. And 7. Insider ownership sits at a massive 45.35%. Explaining why management having extreme skin in the game matters is often skipped over entirely by the mainstream press.
So, if we step back, the crucial point is this absolute tug-of-war at the heart of the stock. On one side, you have this terrifying $10.6 billion debt load, with literally no current operating income to pay the interest. But on the other side, incredibly solid, long-term 20-year contracts securing 9.1 million tons of LNG with highly creditworthy counterparties. This is a binary infrastructure play of the highest possible order.
All right, part 3, Legendary Investors Reality Check. Let's bring in the ghosts of financial legends. If we apply the historical frameworks of the world's greatest value and growth investors, can they justify this $7.12 price tag? The answer is exactly 0. Not a single one of the 3 legendary investing frameworks we tested would touch this stock based on current objective data. Let's break down exactly why. First up, Ben Graham, the father of deep value. NextDecade fails the Graham number right off the bat because you get a mathematically impossible negative square root when multiplying the negative EPS and negative book value per share. And it massively fails his net current asset value test because current assets of $488 million are completely swallowed by over $10 billion in liabilities. Graham would run for the hills. What about Peter Lynch, the champion of growth at a reasonable price? He instantly rejects it too. You cannot calculate a PEG ratio when earnings growth is negative, and Lynch's fair value formula completely shatters when facing a 0% dividend yield paired with a 40 times PE ratio on negative growth. And what about the Oracle himself, Warren Buffett? Well, Buffett focuses heavily on owners' earnings, which are deeply negative here once you factor in those billions in maintenance and growth capital expenditures. His required return on invested capital threshold is around 15% consistently. NextDecade currently sits at a dismal negative 1.38%. Net debt to EBITDA, it's a meaningless ratio here because the denominator is negative. But most importantly, Buffett buys competitive advantages. Today, this company has absolutely no economic moat.
Which brings us to our final section, Part 4, Moat and Final Verdict.
We've run all 21 models, we've dug up the forensic flags, and we've checked the legends. It is time to synthesize this into our final verdict. Based on the average of all applicable standard models we ran today, NextDecade is definitively overvalued relative to its current fundamentals. Every single traditional cash flow-based intrinsic value comes in negative. Buying at roughly $7.12 a share today means you are implicitly assuming 0 construction overruns, perfect timing, and flawlessly favorable future LNG prices. Now, let's define their economic moat using Morningstar's 5 sources: intangibles, switching costs, network effect, cost advantage, and efficient scale. Today, as a development stage company, NextDecade has absolutely no moat. However, if they execute, this will evolve. By the year 2027, when that first LNG train comes online, they could establish a narrow moat through efficient scale, simply because they will be one of the very few massive U.S. export projects in operation. Long-term, if their carbon capture integration works out, they could develop a serious cost advantage through regulatory or pricing edges. So the moat is non-existent today, but potentially expanding in about 3 years.
So here is your clear, nuanced takeaway. NextDecade is not a value stock. It is not a traditional growth stock. It is a highly leveraged, binary bet on the future of LNG. It is essentially a development stage project financing dressed up in public equity clothing. With a $1.8 billion market cap against $12.3 billion in enterprise value, bondholders and lenders are the true primary stakeholders here. Equity holders, you are simply along for a very, very highly leveraged ride.
The financial models are screaming one thing loud and clear, but those hidden operational green flags suggest a storm of future potential. Are you willing to stomach that massive debt for the 20-year contracts waiting at the finish line? The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Use this explanation as your starting point. Dig into those filings and always do your own homework.